Good morning, members. Uh, yeah, welcome to the VCAC meeting. Today we have with us CA Mahesh Gautam Nayak ji as our speaker, who will take us through the practical issues in capital gain in cross-border transactions. I request Shreyans to please give the brief introduction of the speaker. Before that, I request members to rise for the ICAI motto, please.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैत 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 एतद्वैत.
Thank you. I request Shreyans to please give the brief introduction of the today's speaker.
Thank you, Vishal Bhai, for giving this opportunity. Warm welcome all the members and warm welcome to our today's learned speaker, CA Mahesh Nayak. Mahesh is a CA having more than 12 years of experience in the field of international taxation, business restructuring, taxation, transfer pricing, and FEMA. He is currently a partner at C&K Associates LLP. He has prior experience in direct tax practice of EY. He has successfully completed the advanced course in international taxation from International Tax Center, Netherlands. He is a member of the Managing Committee and a convener of the International Taxation Committee of BCAS. He is a regular speaker at various forums on international taxation and domestic tax issues. He has co-authored chapters in the MLI Compendium and Transfer Pricing Compendium of BCAS and International Taxation Compendium of CTC, and co-authored the publication on disclosures of foreign assets and income, an analysis published by the BCAS. He is also the co-author for the monthly international taxation column at the BCA Journal, and also writes column regularly for Mint on personal taxation. With this, request all the members to extend a huge round of applause for the today's learned speaker. Request CA Vishal Joshi to hand over the token, a memento of appreciation, and request CA Pratik Maru to give a contribution to BCA. This request today's speaker to commence the session.
The organizing committee of the Borivali Central CP Study Circle and to the members of the study circle. Good morning and thank you for having me here once again. So the topic for today is some select issues in capital gains taxation in cross-border transactions. What we'll try and do is there are about 6 issues that we have identified. We'll try and cover some of the issues that are there. So basically we will be covering issues related to the exchange rate that is used where a non-resident is selling Indian assets. Similarly, what happens in case where a resident is selling assets located outside India. Then we're talking about the buyback taxation. So as we know that in July 2024 there was a change in the scheme of taxation of buyback. So what happens in the case of treaty? How is it interpreted from where the shareholder, where the buyback is of an Indian company and where the shareholder is a non-resident? So what happens? How does it work under treaty? Then we'll talk about some issues in respect of the India, Singapore, and the Mauritius treaty have a grandfathering clause wherein the capital gains are exempt if the investment was made, the shares were acquired prior to 1st April 2017. There are some issues in that. Then some select issues in terms of valuation. We'll briefly cover those. And in terms of indirect transfer, if time permits, we'll also cover that. Again, practical issues in terms of how does one undertake computation in case of an indirect transfer. So the first issue we are talking about is the exchange rate that is to be adopted when a non-resident sells shares of an Indian company. So let's take a case study here. So you have a US company which sells shares of the Indian company. Right, these shares were acquired in 2015 for $100,000 when there was an exchange rate of 60 rupees per dollar. It is sold to another UK company and it is sold during FY 24-25 when the exchange rate is 85 rupees. So if we see the sales consideration is 80,000 in this case, $80,000 and my cost of acquisition is $100,000. So in terms of dollar terms, there is a loss. But if I convert my sales consideration at today's rate of say 85, cost of acquisition at 2015 rate of 60, then there is a capital gains in INR. So in purely INR terms, there is a capital gains. But in dollar terms, dollar to dollar, there is a loss. Now the question arises is, what happens? Whether it's a loss, do you get a loss, or is there a capital gains that arises? So would there be a capital gains accruing arising to the US company on sale of the shares, or on the basis of the above facts? Now let's look at some of the relevant provisions that are there. You have basically it's an interplay between 3 provisions. So you have the first proviso to section 48, which says that in case of an SSE who is a non-resident, capital gains arising from the transfer of a capital asset being shares in or debentures of an Indian company shall be computed by converting the cost of acquisition and full value of consideration into the same foreign currency as was initially utilized in the purchase of shares, and the capital gains so computed in such foreign currency shall be reconverted into Indian currency. Now you have again rule 115A, which gives a broader understanding of what the first proviso to section 48 is saying, which says that for the purpose of capital gains, first you convert the cost of acquisition at the average TT buying rate and average of TT buying rate and TT selling rate of the foreign currency as was initially utilized in the purchase of the said asset as on date of acquisition. In our case, $100,000. There's no expenditure, so we'll not look at clause B. Look at clause C. For converting full value of consideration arising as a result of transfer of capital asset, the average of TT buying and selling rate of the foreign currency initially used as on the date of transfer of the capital asset, which is $80,000. And then you reconvert the capital gains computed in foreign currency initially utilized in the purchase of the capital asset into rupees at the average of TT buying rate of the currency as on the date of the transfer. So basically, my sales consideration is in USD. Therefore, my original purchase was in US dollars, and therefore I will compute everything in US dollars. So I have in dollar to dollar terms there is a loss of 20,000, and I'll multiply that by 85, that is the rate that is on the date of the transfer, and therefore I would have a 17 lakh loss. That is what Rule 115A says. Now what happens is you have section 112(1)(c), which says where the total income of the assessee includes any gains arising from the transfer of a long-term capital asset, which is chargeable under the head capital gains, the tax payable by the assessee on the total income shall be aggregate of, and in the case of a non-resident, not being a company or a foreign company, subclause C, what it says the amount of income tax on long-term capital gains arising from the transfer of a capital asset being unlisted shares or shares of a company not being a company in which public are substantially interested, as computed without giving effect to the first and second proviso to section 48 calculated on such long-term gains. So if I purely look at section 112, it says computed in rupees. So it says your consideration in rupees 68 lakh, that is at today's rate. 60 lakh was your cost of acquisition, and therefore you have an 8 lakh capital gains. Now question is, what happens? I mean, because there is a mismatch, is there a mismatch firstly, and secondly, what is the provision that is there? So you have a Mumbai ITAT decision, and then we look at, there were some certain aspects not covered by the ITAT, but we look at that. But first let's look at this Mumbai ITAT decision. You have the case of Legatum Ventures a couple of years back, where a UAE company sold shares of an Indian company and claimed a loss after applying the first proviso. Same facts, similar facts, what is there? AO said, I'm going to apply section 112 and there's a capital gains. The assessee said, once there's a loss under section 48, it is to be carried forward under section 74 and there's no gains, and then the question of section 112 does not apply. What does the ITAT say? Section 112 is a special provision which applies exclusively to capital gains on sale of shares by non-resident. It is a well-settled rule of interpretation that if a special provision is made in respect of a certain matter, then that matter is excluded from the general provisions, which is the maxim generalia specialibus non derogant, that is, specific overrides general. And therefore, if two provisions exist which cannot be reconciled, they should be so interpreted that if possible, the effect should be given to both. So effectively, Mumbai ITAT said that 112(1)(c) is a specific provision, and it will override the general provision, and therefore one would need to compute the capital gains in 112 purely, and the gains were held to be taxable. So in our case, there will be a capital gains of 8 lakhs if one follows the decision of the Mumbai ITAT. Now, what are some aspects of which are not being considered by the Mumbai ITAT? So first question, has the non-resident actually made a profit? Look at it from the non-resident's perspective, right? The rupee term really does not make a difference. They had invested $80,000, they had invested $100,000, they are getting $80,000 today. So the question is, in pure terms, from a purely non-resident perspective, there is a loss. Now, if one follows the ITAT decision, it really makes the first proviso to section 48 completely redundant, because 48 only applies in the case of sale or transfer by a non-resident for Indian company shares or debentures. So therefore, it makes it redundant. Is that what the interpretation is? Because ITAT said, no, you cannot make any provision redundant. Second is, the first proviso to section 48 also is specific, because it also applies only in a specific scenario. It only applies in a specific scenario where a non-resident is selling shares of an Indian company or debentures. So therefore, first proviso also is specific, 112 is also specific. So how does one say that specific will override general? Because first proviso to section 48 is definitely not a general provision. There is an absurdity of the view, and we'll come to that subsequently. But now, if one sees section 48, right, there is also a third proviso, not really in the context of 112, but in the context of capital gains arising on sale of listed shares, so under 112A, right? So what the third proviso says in section 48, that provided also that nothing contained in first and second proviso shall apply to capital gains arising from the transfer of a long-term capital asset, being a equity share in a company or equity-oriented fund, referred to in section 112A. So, therefore, if you see let's understand, obviously, the provisions of the Act. The proviso in Section 48, or the Section 48 by itself is a computation mechanism. Section 112 is not a computation mechanism, is not a computation section. It is providing the rate of tax, right? So, if under my computation mechanism there is a loss, can I go and apply a rate of tax section to it the moment there is a loss? That's the question. And which is why, if you see for Section 112A, right? In 112A also, there is a specific carve out in the computation section itself. There is a third proviso to Section 48, which says that first and second proviso will not apply only in the case of a 112A listed shares. But for unlisted shares, for 112, there is no such proviso which is excluding the application of the first two provisos. Second proviso anyway not relevant, but the first proviso. And therefore the question really arises is that what the intention of the law is? Now again, so the next bullet point I've covered, that 112 provides a charging section, and if there's a loss, then does it even come into the charging section if there's a loss under Section 48, which is a computation mechanism? And if one sees, there's an old circular of 1995 which says, CBDT Circular 721, which says that and this is in the context of 112 itself, it says the above phraseology contains two significant expressions: total income and includes any income. The total income is to be computed in the manner prescribed in the Income Tax Act. So set off of losses as per the provisions of the Section 70 to 80 is at a stage which is part of this procedure. When this procedure is adapted for computing gross total income, only the amount of income after set off remains under a head as part of gross total income or total income. So only that income of long-term capital gain which is included in total income would be subject to tax at a prescribed flat rate. Thus, if there was a loss of 10,000 from business and there's a long-term capital gain of 30,000, then after setting off the loss of 10,000 with long-term capital gains, only 20,000 would remain under capital gains, and that would be subject to the flat rate of tax and not 30,000. Since the amount of capital gains, long-term capital gains included in the total income is 20,000. So obviously that is assuming that it is above the exemption limit. So the CBDT circular says that if you have a loss, because what does 112 say? Where the total income of an SSE includes any income arising from the transfer of a long-term capital asset. So the moment I don't have an income, and in my total income there's a loss, then the question is, do I even need to move forward? So yeah, so the CBDT circular clearly provides that if you have a loss under any other head which you are going to set off on the capital gains, then only on the net income you apply Section 112. So can one not apply the same principle here? Because effectively it is saying, first you do your computation mechanism under the earlier provisions of the Act, as per the computation mechanism under the Act, and then you come to the rate section under Section 112. So when there is a specific that is already there, this CBDT circular was not considered by the Mumbai ITAT. So would that really change the view? Another thing is, here you had a cost of 80. So therefore, you have a cost of 100,000. Suppose the cost was $60,000, right? So then what happens, right? So now if you see Section 48, read with Rule 115A purely, then there is a capital gains of 17 lakh. We have seen that because 20,000 is the gains and 85 rupees is this thing. But if you go to Section 1121C, it says don't give effect to 48. Now, therefore, it will be taxed at 32 lakhs. It will be the capital gains because my gains are computed at the original cost of acquisition. Now, in this case, effectively, that means, so obviously, even taking this view that I have to apply Section 48, then basically what it says is, effectively what it means is, I have to apply Section 48 computation mechanism. If there is a loss, that's it, right? It has to be either set off against other income or carried forward under Section 74. I don't go to 112 at all. But if I have gains under Section 48, Then I go to section 112. 112 says this is the rate, but hold on. When you're going to apply the rate, you compute in a different mechanism. Don't consider first proviso to section 48. And therefore, if I have gains, you compute the gains purely in INR. But if I have a loss, you compute purely in USD and don't come into that. That is where the this thing is. So in my view, this would be a better position, that you compute your gains under section 48 while Legatum Ventures has held otherwise, because both are, both the first proviso to section 48 as well as section 112 are equally specific. None of them are really, this is not a case of specific overriding general with due respect to the ITAT. And therefore, if I have a loss under the first proviso to section 48, I stop there, I don't go to the charging section. If I have a gains, I go to the charging section and then I compute gains. Obviously, it's not the best of this thing, because then I have to recompute gains under section 112, but that would at least make sure that I'm giving effect to both the first proviso to section 48 wherever applicable, as well as section 112. Now, coming to the second issue, in case of a resident, right? So you have similar facts, except it's flipped. You have an Indian company. An Indian company sells shares of a US company, which is acquired in 2015, where the purchase cost was $100,000 and the exchange rate is as was 60 at that time, and now it is sold at and let's assume it is sold before 23rd of July 2024, that it was sold before 23rd of July 2024 at $80,000. So again, in dollar terms, same facts, I made a loss, but purely INR terms, I have made capital gains. Now the question really arises is, can this gains, or is there a loss or is there capital gains? And secondly, can I claim indexation? This is because it is prior to 23rd July 2024. So, especially relevant when one is doing the return filing for FY 24-25. So, obviously, the first proviso to section 48 in this case does not apply, because first proviso to section 48 applies only in the case of a non-resident selling shares of an Indian company. Similarly, 112, 1C does not apply, because that only applies for non-resident selling shares of an Indian company. So we are not getting into that. That is not the controversy now here. So those provisions don't apply. What applies is, let's look at the second proviso to section 48. That is relevant. Second proviso to section 48, as we all know, provides indexation, obviously where the transfer takes place prior to 23rd of July 2024. And it applies to long-term capital asset, transfer of long-term capital asset, other than capital gains arising to a non-resident from transfer of shares of an Indian company. So second proviso, obviously indexation is not available to a non-resident selling shares of an Indian company, but in our case, this is shares of a foreign company that is sold by an Indian company. So therefore, the second proviso to section 48 can apply. Now the question is, again, you have earlier in the first proviso to section 48, you had rule 115A, which was applicable. Here you have rule 115, which talks about what is the rate of exchange for the calculation of capital gains. So it says rate of exchange, rule 115 provides the rate of exchange for any income that is derived or accruing or arising or received in foreign currency. So there, what it says is, in case of house property profits and gains and income from other sources other than dividends and interest, then you apply the rate of last year or previous year. But in respect of capital gains, subclause F, so rule 115.1, the explanation 2F, it says in respect of income chargeable under the head capital gains, then the last date of the month immediately preceding the month in which the capital asset is transferred. So therefore, in this case, you have, of course, there's a proviso which says that if there's a TDS that is tax is deducted, then you go to rule 26. when a non-resident is buying shares of a foreign company from an Indian resident, uh, TDS does not apply, and therefore, because assuming that the non-resident does not have any presence, etc., in India, because 194Q, etc., will not apply. So in that case, this proviso really does not apply. But you have sub-rule 2 also, which says nothing contained in sub-rule 1 shall apply in respect of income referred to in clause C, uh, where such income is received in or brought to India on his behalf before the specified date. So what does the second proviso say? Second rule say? Sub-rule of Rule 115 says that if you have brought the money to India, then you use that rate before. If you brought the money to India before the specified date, then you use that rate and not the rate that is provided in Rule 115. Now, you have the Supreme Court in the case of Chaugule and Company, where it said that if the foreign company has foreign currency is received by an assessee, and that has been converted into rupees before the specified date, the question of application of Rule 115 really does not apply. Rule 115 does not lay down that all foreign currencies received by an assessee will be converted into rupees only on the last date of the accounting period. It is only fixes the rate of conversion foreign currency. So if there is no foreign currency to convert on the last date of accounting period, then no question of invoking Rule 115 will arise. And it also says that clause 2, which was introduced on 1st April 1990, is really clarificatory and does not bring about any change in Rule 115. Now, the Supreme Court has held that. Now, there the facts were slightly different. There the facts were about in respect of business income, right? It has to be read in the context in which the Supreme Court has laid down that law. There it was business income, where the rule itself provides that the exchange rate on the last date of the previous year is to be applied. So one can distinguish between capital gains, because what Supreme Court was interpreting was in respect of subclause C, whereas we are covered in subclause F. So here this was in case of business income, and the rule itself provides for exchange rate on the last date of the previous year, and therefore we will be able to distinguish that principle laid down by the Supreme Court, and that it would not apply to other streams of income where a different date is for considering the exchange rate is to be considered. For example, in capital gains, where last date of the preceding month is to be considered. Another aspect is that if you see Rule 115, it talks about income accruing or arising, or deemed to accrue or arise, or received or deemed to be received by him. And therefore, rule itself distinguishes between income accrued and income received. And therefore, in that context, Chaugule Industries was correct that income was received in India at an earlier date, and therefore I had to consider the rate at which it was brought to India, and I don't consider the last date of the month, last date of the year in the case of business income. And therefore the rule itself distinguishes between income received and income accrued. Similarly, if you take the observation that Rule 115.2 is clarificatory, again let's read Rule 115.2. It says nothing contained in sub-rule 1 shall apply in respect of income referred to in clause C. So it only applies to clause C. It doesn't apply to the other sub-clauses of the sub-rule, and therefore it is only covering business income, income from house property, and income from other sources other than dividend and this thing. And again, secondly, another last aspect is that, okay, even if one applies the Supreme Court decision, what does it talk about is income arising from capital gains, right? Income chargeable under the head capital gains. So under Rule 115, I have to compute my income first, and then I have to convert that income into Indian currency. So therefore, I had to apply it on the income component, which is capital gains amount, and not on the cost of acquisition and the sales consideration separately. Therefore, that is, so in my view, in this case, one needs to again compute your capital gains in foreign currency. Whatever is the answer when you convert the capital, when you have computed the gains in foreign currency, that capital gains or loss, whatever it may be, that you convert into the INR in accordance with Rule 115. Now there again, you have one decision of the Mumbai ITT again, ICICI Bank. Now if you see, actually, so in that case, and there was an Indian company which had sold shares of Russian subsidiaries. Now there the department's view, there was a 263 proceeding that was there, where the PCIT said that you cannot take indexation. Indexation is only available when capital assets are acquired in Indian currency, and you have to convert the cost of acquisition as on the date of the acquisition, and sale consideration as on the date of the sale, and then compute the gains in INR. So again, there, if you see the decision, again the facts are a little bit confusing in the sense that it clearly first says that the Indian company had invested in Russian rubles, but then they said no, they're not invested in foreign currency but in INR, and therefore, but I think more importantly what the ITAT held is that you cannot get the benefit of indexation as well as the computation of the gains in foreign currency, which is not in accordance with the Act. Now, again, with due respect to the ITAT, I mean the facts suggested that it was invested in Russian rubles, it was sold in Russian rubles, there was a liquidation, so there was a sale, or it was a sale, sorry, it was not a liquidation, so there was a sale, so therefore it was sold in Russian rubles, and therefore, obviously when I'm transferring, I'm an Indian company, when I'm transferring, I'm going to obviously transfer equivalent of Indian rupees, but that doesn't mean, that I have done the transaction in Indian rupees. My consideration, my agreement, everything is in foreign currency, and therefore, not sure whether ITAT has, missed that point, because when because they're talking about investment in Russian rubles, but then suddenly they're saying that they are not invested in foreign currency, they are invested in INR. Again, the second point of ITAT, that you cannot get indexation as well as forex benefit both. Now, again, with due respect to the ITAT, that is not what the provision says. If you see the second proviso to section 48, nowhere does it say that gains computed in Indian currency. It says whether long-term capital gains arising from the transfer of a long-term capital gains, other than gains arising to a non-resident, which is not our case, then you will get the benefit of indexation. So, obviously, so in my view, and again, Rule 115 talks about what is the computation mechanism. So, in my view, you compute the gains in foreign currency, take the benefit of indexation in foreign currency, and you can get the benefit of both, because Rule 115 asks you to convert the income, and indexation is obviously applicable. In the case of ICICI Bank, what Mumbai ITAT did is gave the benefit of indexation, but it converted the entire capital gains in INR, as if cost of acquisition in INR as on that date, and the sale in INR as on today's date. So that's how the ITAT finally held. But in my view, with due respect to the ITAT, that may not necessarily be the right decision, or may not have considered all those aspects, and therefore, one has to consider the income, and I should get the benefit of indexation. Again, very limited aspect, because it is only applicable in this year, because after 23rd July 2024, anyway, in the case of a resident selling shares, there is no capital gains, there is no indexation, it only applies in case of immovable property, and therefore that aspect of indexation is anyway limited in that aspect, but in any case I have to compute my capital gains in foreign currency. Now coming to the third issue that we want to cover. Yeah, so that is a challenge. So practically, I think one uses the RBI or the reference rate, because otherwise you have to go to the SBI and actually pay and get this thing. Now, of course, I think, like you said, I think it is post 21 that I think there are some sites which have started, having the TT buying rate and TT selling rate being disclosed. But otherwise, it is very difficult. And I honestly, I mean, it is a practical this thing that today, I mean, fortunately, I don't know, I've not come across any decision where the department has tried to say that no, you should have taken TT buying rate. But otherwise, I agree that it's a pain in the sense that obviously when every time I undertake a transaction, I cannot go to go to SBI, pay and get the rate. I mean, that is something that has to really. But practically, I think one then goes with the RBI rate or the rate that you're actually accounting at this thing. So, in NRE, if you are computing this thing is anyway happening in INR. If it is happening in dollars, then yes, then you can. Correct. So then there's no problem. But your income has to be in. So your original purchase has to be in foreign currency. It doesn't matter whether it has to be brought into India or from the NRE account. So that should not be an issue, in my view. Right. So you had $100,000, right? You got interest of say $5,000, right? No. So let's assume that in dollars it is 105,000, right? Now your opening balance because of exchange rate was X in INR, and closing balance because of this thing is yeah, yeah, right. Logically not, but I think one will need to look at ICDS if it is so in case of individual it should not be. If there's no business income, yeah. If I'm talking about interest, if it was business income, then you need to look at ICDS because whether there's anything. If it is purely individual, absolutely not. You have to only compute the interest. You have to only offer the interest at the applicable rate under Rule 115. Because of dollar terms, because there is a fluctuation, appreciation. It's not really income per se. Yeah, that's the way I would look at it. Even though you may have gotten the entire bank balance, you must have closed the bank during the year and got it back also into India. In my view, it is not, because it's not a capital gains. It is both ways. I would feel that it's not. Yeah, because there's nothing. There's no charging section. How will you charge it as what? Right. It's not really an income in that sense. Right. So. Sorry. Yeah. So coming to buyback. So we have. So again, buyback. I think we have seen sort of like dividend. I think there's been a sort of a mix of there's been a pendulum swing of how it is taxed. So till 1999 it was taxed, or from 1999 it was taxed only in the hands of the shareholder. So there was a specific exclusion from the definition of dividend under section 222 earlier, and it was taxable as capital gains under section 46A in 1999. In 2013, as we know, buyback tax was introduced, 115QA, whether it was 20% plus surcharge cess, and the buyback income was then exempt in the hands of the shareholder. At that time, it was only applicable to unlisted shares. Listed shares were still outside, so listed shares buyback was covered under 46A at that time. Then in 2019, the buyback tax was extended to listed shares as well. And then in 2024, again, from 1st October 24, in last year's budget, there was a change where now it is taxable again in the hands of the shareholder, but with the twist, as we all know, that the entire consideration received is dividend under section 222F, and your entire cost of acquisition is considered as a capital loss under section 46A. And 115QA and 1034A are no longer applicable. So that is what we all know that has happened. Now obviously, buyback is different from capital reduction in terms of the application in under the act, because cap reduction today says that to the extent of accumulated profits is considered as capital gains, is considered as dividend, and balance amount, while it is silent, would obviously become capital gains, because there is obviously a reduction or the shares. Obviously, capital reduction I'm talking about where the shares have been extinguished, not where the value of the shares has been reduced, because again, there is a separate controversy there where there are decisions which have held that if from face value from 10 to 5 it goes, then it's not a really a capital, a transfer of a capital asset. But I think leaving that controversy aside, because not relevant, when I'm talking about transfer of shares, in case of a capital reduction, the balance amount is taxable as capital gains. In buyback now, it doesn't matter what your accumulated profits are, the entire amount that is received is considered as dividend, and whatever is your cost of acquisition is considered as a capital loss. Now, let's look at a situation where you have a non-resident shareholder. He has shares of an Indian company. Now there's a buyback, right? Of that Indian company, he's tendered the shares for buyback, etc. That's done. Now the question arises is, okay, under the domestic law, I have dividend and I have capital loss that is provided from 2024. What happens in case of a treaty? So let's understand first, and there are two sort of baskets it can go under. It can either be considered as dividend under the treaty, or it can be considered as capital gains under the treaty. So let's look at the definition of dividends. So you have the OECD Model Convention Article 10.3, which defines dividends, and we look at other specific treaties of India also. We look at that in some subsequent slides. But let's first look at the OECD Model Convention. What does it say? The term dividends, as used in this article, means income from shares. The rest of it is not relevant. As well as, and you can see the highlighted portion, income from other corporate rights, which is subjected to the same tax treatment as income from shares by the laws of the state of which the company making the distribution is a resident. So, the OECD model commentary, so we saw what the convention says. The model commentary says dividends is generally meant, what is dividends is generally the distribution of profits to the shareholders by companies. And then there's a para 28 which says that it doesn't matter whether it is paid out of current profits or are derived from reserves, that is profits of previous financial years. But normally distributions by a company which have the effect of reducing the membership rights, for example, payments constituting a reimbursement of capital, are not regarded as dividends. That is what the OECD commentary says. So OECD commentary says that if there is a reduction of capital, where there is a reimbursement of capital is what they are saying, where the payment which constitutes a reimbursement of capital in any form, then it is not dividend, it is capital gains. It is not dividend, that's all OECD model on Article 10 says. Now we'll come to first Article 13, which talks about capital gains. Article 13(5), which says gains from alienation of any property other than referred to in 1, 2, 3, 4. So typically in your capital gains article you have the first para which talks about transfer of immovable property, then it talks about movable property of a permanent establishment. Third para typically talks about transfer of shares where they're deriving a substantial value from immovable property in the source such state, etc. So it says other than those shall be taxable only in contracting state in which the alienator is resident. Again, treaty to treaty it will change, but what does alienation of property mean? The OECD model commentary says that it is used to cover particular capital gains resulting from the sale or exchange of property, and also from a partial annihilation, the expropriation and transfer to a company in exchange for stock, sale of right, the gift, and even the passing of the property on death. Now, let's look at what were the judicial precedents before this amendment came in, right? In the case of a buyback, you had the Mumbai ITAT in the case of Goldman Sachs, which is said, as well as the AAR in the case of Armstrong World Industries, Mauritius, which has held that it is capital gains. This is prior to even 115 QA, because once buyback tax came in, it was not taxed on the shareholders, it was taxed in the hands of the company. So there was no discussion on that. But prior to 115 QA coming in, so if you see decisions of So prior to 2013, the law prevailing before 2013. So you have Mumbai ITAT and AAR both saying that buyback by general is covered under Article 13 capital gains and not dividends. Again, let's look at some other this thing. So you also have the concept of deemed dividend under 222E, where Mumbai ITAT in KIIC held that, and it says same tax treatment as income from shares in the country of distributor of dividend is in the context of third facet. So what is important is, I think, is it income from other corporate rights which is subject to the same tax treatment as income from shares. So what does Mumbai ITAT in KIIC held? That same tax treatment means that anything that is treated as dividend under the Indian context will be considered as dividend under treaty. That is what Mumbai ITAT has held. On the other hand, Rajiv Makhija, Delhi ITAT has held that Article 10 nowhere deems income in the form of deemed dividend that can be considered as tax net. It is only income from shares or other rights, not being debt claims or income from shares which are treated as this thing by the company making the distribution, which falls under the definition of dividend. The amount of a loan cannot be considered as a dividend that is paid in Article 10 of India-Canada DTAA. So, therefore, you have two sort of contradictory judgments in the context of deemed dividend. So before we get into the whole how it is to be treated now, in deemed dividend, Mumbai ITAT has held deemed dividend, if it is dividend under the Income Tax Act, it is dividend under the treaty. Delhi ITAT has said no, a loan that is given just because you are deeming something under the Act, it cannot be dividend under the treaty. Now, when section, again some context, when Section 46A was introduced when, in 1999, when capital gains, when buyback was to be considered as capital gains. So, what the Memorandum to Finance Bill says, that there are two principal issues, and those are the provisions have been brought in to cover those issues, that whether this buyback will be considered as deemed dividend under Section 222, and whether any capital gains will arise. And therefore, they brought in the exception to 222 earlier, which held that buyback is not considered as dividends at that time, and they brought in 46A saying that buyback is taxed as capital gains. Now, let's look at what the Memorandum to Finance Bill 2024 says, that both dividend as well as buyback are methods for the company to distribute accumulated reserves, and thus ought to be treated similarly. And in addition, there is also extinguishment of rights for the shareholders who are tendering their shares. Now, we looked at what the what the OECD model says. Now, let's also quickly look at some of the key Indian treaties. What do those treaties say? So, and why? Because in my view, I think the way the implication would depend also on how the treaty is worded, and why we'll come to. India, France, in the definition of dividend in the Article 10 says, it says as well as income from other corporate rights treated in the same manner as income from shares, and any other item which is treated as dividend or distribution under that law, right? Capital gains, I don't think there is any significant this thing. Again, India, US says on the other says income from other corporate rights which are subject to same tax treatment as income from shares in the country in which the company is making the distribution, and income from arrangements including debt obligations carrying the right to participate in profits to the extent so characterized under the laws of the contracting state in which the income arises. Similarly, India, Germany says other income which is subject to the same tax treatment as income from shares in the country of source. India, Canada says as well as income assimilated to income from shares by the tax law of the country of source. India, UK says as well as any other income which is subject to the same tax treatment as income from shares. So, therefore, there is a difference if you see in India, France and India, US. India, France says as well as income from any other corporate rights which is treated as income from shares. Now the question is, or before we come to that corporate rights aspect, clearly where you have language such as India-Germany treaty, India-UK treaty, India-Canada treaty, which says Any other income which is treated as income from shares under domestic law is treated as dividend here also. So therefore, India, Germany, India, Canada, India, UK says, if domestic law is treating it as dividend, you treat this as dividend under treaty as well. And therefore, under these treaties, in my view, there is a view that you can consider it as dividends. However, where you have language such as India, France, where it says income from other corporate rights treated in the same manner as income from shares. So, there have to be two things that have to be satisfied. One, it has to be treated as income, it has to be treated as dividend under domestic law, yes, but this income also has to be income from other corporate rights. Now the question is, really, is buyback income from other corporate rights? In my view, not, because I am sort of course, again there is a view that is there that the fact that I have a right to tender my shares for buyback is a corporate right and therefore it is an income from corporate right. But in my view, it is not an income from the right, it is an income from the extinguishment of the right or extinguishment of the asset, and therefore the right has to be distinguished then as from income from rights, and therefore in my humble view, that income from, where it says income from other corporate rights, it may not be considered as dividend. Another aspect one needs to consider, and because you had the recent decision of Nestle which interpreted the term is, right? So the question is, India-UK treaty says any other income which is subjected to the same tax treatment as income from shares, or India-Germany treaty says any other income which is subject to the same tax treatment. Now if I follow the Nestle judgment strictly, can I say is what Nestle had said has to be read as when the treaty was signed, and therefore can I say that I have to look at when India-UK was signed, when India-Germany was signed, what was the treatment at that time under domestic law in India, and I follow the same treatment, and therefore I should do that. In my view, that may be sort of a far-fetched argument, because again Nestle was in a very specific context. Of course, right, wrong, I think is separate, but again the point is cannot be, I mean, is not really a term that needs to be really defined, and therefore one may not necessarily use that interpretation, but again that's an argument that one could possibly take. Again, the question really is, am I overriding the treaty, right, by changing the domestic law? Possibly not, because obviously the question is, this is not a question of really overriding of the treaty. I am changing the domestic law in accordance with my provision. It's applicable to all shareholders, so it may not be considered as an overriding of treaty. So yeah, so in my view, where the language says income from other corporate rights, it may not necessarily, I mean there is a gray area when one can, in my view possibly you may not be able to say that it is income from dividend, and therefore this 222F may not necessarily fall under dividend under the treaty itself. But where it says any other income which is treated as income from shares, there clearly if it is buyback treated as dividend under the act, you look at the same treatment under the treaty, as well. Now, another interesting aspect is in case of, let's assume that you are following the treaty, right? Now, can I do a double dip in a sense? Can I say that, okay, my section 222F says it is dividend. I am taking the interpretation that because it is income from shares, it is dividend under treaty. So under my domestic law, dividend to non-residents is 20 plus surcharge cess. Under the treaty, it could be 10%, 5%, 15% as the case would be. So let's assume that under India-UK treaty, I'm offering it to tax at 10%. Now, done, right? Now, what about the capital loss, right? Let's assume I have a capital loss because section 46A allows me the capital loss. Now, can I take the capital loss? Because can I say that I am going to tax dividend, because let's look at it this way, that there are two consequences to buyback. One is part of it is taxed as dividend, part of it is given as capital loss. So can I say to the extent of part taxed as dividend, I am going to go under the treaty and claim the benefit of the treaty, but my capital loss is a consequence, and therefore I am going to claim the capital loss under section 46A. If you see the proviso to section 46A which has been inserted, provided that where the shareholder receives any consideration of the nature referred to in subclause F of 222, in respect of any buyback of shares that takes place after 1st October 24, then for the purpose of this section, which is section 46A, the value of consideration shall be deemed to be nil. So does so does so ha so what does it have? So if does anyone have a view on this? Can I say that for the dividend taxation I'm going to take the treaty, and I'm also going to be able to for capital loss I'm going to take the carry forward of the capital loss? Any views on this? Okay, so if one looks at the proviso to section 46A, it just says if there is any consideration which is referred to in the nature of 222F. Am I not treating it as a dividend under domestic law? It is a dividend under domestic law. I am only taxing it under the treaty, right? The moment it is dividend under domestic law, my consequence is automatic under section 46A in my view, and therefore I can very well consider the income as treaty, dividend as, under the treaty get the lower rate, as well as carry forward the capital loss. Of course, it has to be tested, but in my view, the proviso does not say if it is taxed as dividend under domestic provisions, right? It just says so long as it is considered as dividend, which is covered under 222F, you will get a capital loss. If it has been notified, yes. Now with the Nestle judgment, it has to be notified, no? So if the MFN has been notified, so if you see actually most of the treaties where there's been a notification, when you go to the income tax site, when you read the treaty itself, it automatically takes the automatically the update. So effectively, very few cases where there has been a notification, those have already been sort of modified when you look at the treaty itself. So treaty will always, no. So dividend, I don't think there's any definition. Definition dividend, I'm not sure whether one can consider that. So you're saying you take the treaty definition under the of dividends. Is that the case? If it has been notified, see dividend. Any definition of the term comes under the scope, right? So MFN typically says rate or scope. If there's any rate or scope which has been negotiated subsequently, which is more beneficial, then you can apply that. Now, if you see wherever there's been a notification, it has always been on the rate. On the scope, they have never notified it. Which is why, your earlier decisions of fees for technical services under India-France, for example, India-France, fees for technical services, it doesn't include a make available. But because of the MFN clause, people used to apply, and high courts have also upheld it at that time, Sordia, etc., that your MFN clause of other treaties, subsequent treaties, provided a lower or better scope, and therefore you could apply that scope. And which the Supreme Court has said, no, to the extent only notified, you can do it. To the extent not notified, no change in the treaty. So, therefore now, there's no notification of any scope change in the definition, etc. So, MFN today practically has no impact as such, except to the extent of rates wherever they have reduced. For example, India-France also, earlier it was 15%, because when India-Germany came in, it became 10%, so they changed the rate to 10%. But they did not change the scope. So they only notified the change in the rate. Another aspect is so it depends. If you have subsequent capital gains, yes. If you don't have capital gains in the case of a non-resident, obviously then it's a dead capital loss. There's nothing else you can do. Correct. So I have capital gains then? In my view, no, because it's a capital loss that is purely provided under the section 46A, and therefore in the capital gains computation, definitely I can claim this loss. So again, it becomes limited because for a non-resident, obviously if I have multiple transactions, it helps. So for example, if I'm selling, I'm doing buyback of shares, or I have other capital gains also in India, then yes. Otherwise, typically it's a dead capital loss, not because only because I don't have any gains. But if I have gains, definitely I can use this. Right. The other aspect is, right, so in India, so we saw that we are trying to take, treaty benefit for dividends. Now let's look at India, Mauritius and India, Singapore, right? Because as we know, if the shares were acquired prior to 1st April 2017, you get a capital gains exemption that you had, because that is still grandfathered. So India, Mauritius, can I say that my dividend under the domestic law is capital gains, my dividend, to the extent of dividend under capital, to the extent of dividend under the Act 222F, I look at my capital gains article and say I had acquired it prior to 1st April 2017, get the exemption and carry forward the loss. Can I do both? Right? So let's look at Article 10 of India, Mauritius. Again, it says dividend means, and if you see the second line, it says income from other corporate rights which is subject to same tax treatment as income from shares. So therefore, possibly one can take the view that it is not dividend under the India-Mauritius treaty, this buyback, it is capital gains. And under capital gains, if it is, and again capital gains, the definition of, so capital gains, if you see the language, capital gains is, in income tax it is gains arising on transfer of a capital asset, whereas in the treaty it talks about alienation of any property. Now normally alienation of property should be the same meaning as transfer, but India Mauritius in fact goes one step further and even defines it, saying that alienation means sale, exchange, transfer, relinquishment of the property or extinguishment of any rights. So therefore, effectively, the chances are, I mean, you have a stronger position to say that this is, buyback is nothing but capital gains under the treaty, and therefore it is not taxable because I had acquired it prior to 1st April 2017 and is exempt under Article 13(3)(a). And then the question is, okay, so when you taxed me under 222F, I have gone with treaty and done whatever, but it is still dividend under 222F, maybe not taxed because of treaty, but 222F, and therefore I should get a capital loss. If you are following the earlier view where you are saying that take dividend under the treaty and claim a capital loss, possibly yes, you can take that view, but again, subject to, possibly subject to litigation, because you're trying to do a double dip, but which you're trying to do in that case also, because you're trying to get both in that sense. But your only thing is, the difference is, I'm trying to say that it is dividend under the treaty, under the Act, capital gains under the treaty, and I'm also carrying a capital loss, right? Because technically, if any capital loss is there in respect of shares which have been acquired prior to 1st April 2017, that also should be exempt. But I'm saying no, for the capital loss, I'm not going to apply the treaty, I'm applying the Act, right? So therefore, that seems to be a little bit of an aggressive position, and therefore in my view, in this particular situation, my capital loss also should be, I cannot, for the same stream, because it's one stream of income, it's not double stream of income, right? It's a consequence, and if I'm saying it is capital gains, buyback is capital gains, then whether it is dividend, whether it is capital loss, 1st April 17, if it is prior to 1st April 17, I cannot tax it. And similarly, I cannot claim a loss also. So in my view, in case of Mauritius, it is either fully exempt, so treaty and dividend as well as no loss, or you tax it as dividend under treaty and claim a capital loss. Now we looked at buyback under Indian company, of an Indian company shares. What about if there's a buyback of foreign company, right? So you have an Indian company which is invested in shares of a Singapore company which are bought back in accordance with Singapore tax law. How would it be taxed? If you see section 222F, it is payment by a company on purchase of its own shares from a shareholder in accordance with the provisions of section 68 of Companies Act. Therefore, 222F only applies to buyback which is done in accordance with section 68 of Companies Act 2013. Obviously, if I'm doing buyback of a foreign company, that will not be subject to Companies Act 2013 section 68, and therefore it doesn't cover under section 222F. Then what happens? So it is not dividend. Then what happens? Section 46A says, where a shareholder, so section 46A, that has not been amended. Only a proviso has been added, right? Section 46A says, where there's a buyback, it is a capital gains. But it is only there's a proviso that has been added now from October 2024 that where it is considered as dividend under 222F, then your cost of acquisition is 0. So the first part of the section still continues. And therefore, in this case, when I'm doing a buyback of a foreign company, I will not be, it will be taxed as capital gains for the Indian company. Right. So now we have gone through the third issue also, buyback. Now, underlying tax credit. Yeah. Subject to Singapore tax law, because you are talking about Indian company shares. What are you talking about? Indian company shares being bought back by foreign company, right? I mean, Indian company is buying back his shares from a shareholder of foreign company, right? So in Singapore, Singapore does not tax dividends today. So underlying tax credit really does not make sense from a Singapore shareholder perspective. So you're talking about this example, sorry. In this example, is receiving from foreign company. Correct. So yeah. So in this case, yeah. So valid point. So what Sir is trying to say is, India, Singapore, the elimination of double taxation, the foreign tax credit article says, in case of a tax credit, not only will you get credit for the taxes that you have paid in Singapore as a shareholder on the dividend, or in Singapore, but the company which has also paid the corporate tax, you will also get the tax credit for that. And therefore, Singapore has a tax rate of 17%, company has paid tax of 17%, so you get credit of that. In my view, yes, if I don't have the language of the India-Singapore treaty, but is it considered as dividend? Can buyback be considered as dividend under the India-Singapore treaty? When we need to look at that, is it treated as dividend under the India-Singapore law first? If it is not treated as dividend under Singapore law, chances are it will not be considered as dividend under treaty also, because I have to look at how that country is looking at it, because that's the country of source. And if they don't consider it as dividend, then it will not be considered as dividend under the treaty, and in which case I may not get that benefit. But one will need to look at that case. There could possibly be this thing one will need to look at, if it does. Yes. Whether it is dividend under Singapore law, and because what I understand is buyback is possibly not dividend under Singapore law, it is capital gains, but I'm not sure. So if it is a similar language, like say up to accumulated profits it is dividend, then to that extent you will get the credit of the taxes that are paid by Singapore. So you are taxing it as capital gains, which is taxed at 12.5% in India, but you will get the benefit of 17% credit, so you will not end up paying any tax. Possibly, if you take that interpretation. I mean, you'll have to look at that specifically, but yes. Now we come to the next issue. So we briefly touched upon the grandfathering provisions under India, Singapore, India, Mauritius. So you have Article 13(4)(a) of India-Singapore Treaty. So as we all know, Mauritius, Singapore, Cyprus, all of these had exemption for capital gains, which has been, subject to litigation, use, misuse, a lot of things. There's a lot of litigation on that, gone up to Supreme Court a couple of times. Now, in 2017, so 2015 or 16 onwards, India started renegotiating the treaties with Singapore, Mauritius, Cyprus. Cyprus, there was very limited transactions, but obviously at that time it was in fact a non-cooperative jurisdiction also for Section 94 Cyprus. But I think leaving that aside, mainly Mauritius and Singapore, from 2017, India did away with the capital gains exemption, but it grandfathered the shares that were acquired prior to 1st April 2017. So, Article 13 of the India-Singapore Treaty, and the language is pretty much similar in India-Mauritius also, so similar things could apply there. So, Article 13 of the India-Singapore Treaty says, subclause 4A, para 4A says, gains from alienation of shares acquired before 1st April 17 in a company which is resident of a contracting state shall be taxable only in the contracting state in which the alienator is resident. So, gains from shares of a Indian company by a resident of Singapore shall be taxable only in Singapore if those shares were acquired prior to 1st April 2017. If they are acquired after 1st April 17, then it will be taxable in each respective state. So India will have a right to tax. Now let's take a scenario. I had acquired convertible preference shares. So Singapore company acquired convertible preference shares in 2014, which were converted in 2019 and sold in 2025, right? So I had preference shares in 2014. 2017 they were preference shares. They became equity shares in 2019 and they were sold in 2025. The question is, can I get the benefit of the India-Singapore or India-Mauritius, in this case India-Singapore tax treaty? So you have, first let's look at the domestic law. You have capital, typically you have capital exemption on the conversion, right? So when it was converted, 4710B gives an exemption. You have section 242A1 HF, which says that the period of holding shall go back to when you had acquired the preference shares. You have section 492AE, which says your cost of acquisition will go back to the cost of acquisition of those preference shares. And therefore, under the domestic law, there is a complete pass-through for this. So under domestic law, I will go back to the date of acquisition of the preference shares. I will go back to the cost of acquisition of the preference shares, and then I will compute the sale of capital gains on the sale of the equity shares accordingly. Now the question is, under treaty, can I consider it as grandfathered? Because in 2017 they were in different form in preference shares. Today they are in different form in equity shares. So you had Delhi ITAT in the case of Sarva Capital, where it was a Mauritius company there. Mauritius company sold shares of an Indian company. Preference shares were acquired prior to 1st April 17 and were converted after that. Now, there it held that, and those were compulsorily convertible preference shares, so CCPS. So it says that undoubtedly the SSE has acquired the CCPS prior to 1st April 17, which stood converted into equity shares as per the terms of its issue without there being any substantial change in the rights of the SSE. As rightly extended by the Learned Council, conversion of CCPS into equity shares results only in qualitative change in the nature of rights of the shares. The conversion of shares into equity shares, CCPS into equity shares, did not in fact alter any of the voting or other rights with the SSE at the end of the company which is who had issued the shares, Veritas. The difference between CCPS and equity shares is that preference share goes with preferential rights when it comes to receiving dividend or repaying capital, whereas dividend on equity shares is not fixed but depends on the profits earned by the company. Except these differences, there is no material difference between CCPS and preference equity shares. Moreover, a reading of 13.3A of the tax treaty, which is similar to 13.4A of the India-Singapore treaty, 13.3A of the Mauritius treaty says that the term used is gains from alienation of shares, and therefore CCPS is also shares, and therefore those shares had been acquired prior to 1st April 2017, and therefore you should get the benefit of grandfathering. So Sarva Capital in this case held that if you had acquired shares, preference shares prior to, convertible preference shares prior to 1st April 17, converted them post that and now you are selling them, you should get the benefit of grandfathering. Now, however, the challenge with the Delhi ITAT in this case is, again, it is, initially it has given the logic saying that there is no change in the voting rights, etc. from CCPS to shares. It has gone into all that. And there it is saying CCPS is nothing but shares, preference shares, equity shares. The treaty does not talk about equity shares or preference shares, it just talked about shares, and therefore I held CCPS before. So what if I had, so interestingly, if I follow this Delhi ITAT decision, what if I held compulsorily convertible debentures before, right? So let's assume instead of preference shares, I was holding compulsorily convertible debentures in 1st April, when 2014, converted those debentures into shares post 17 and sold those shares. Now, interestingly, if I had not converted those debentures, right, I am selling, then I would have sold debentures. I have not sold shares because I have not converted them. And therefore, what is taxable only under the new treaty, modified treaty, is only gain from alienation of shares acquired after 1st April 17. So, if I had acquired, I mean, I am selling debentures today. If I am selling debentures before, without converting, then they would have been exempt under the treaty. But because I have converted them after 1st April 17, into equity shares and then sold the equity shares, while the conversion would be tax neutral under the India income tax itself, that is considered as capital gains taxing if I follow the decision of the Sarva, Delhi ITAT, because it is equating only shares with shares. So if I had transferred debentures without conversion, they would have been exempt. But now because I had converted them, they are taxable. That is what, if I just follow the principle. And we'll come to what should be the correct view, or at least as per me, what should be what is my view. But there are other situations that could arise, right? We're only talking about conversion. There could be other situations. What if I had received a gift after 1st April 17? Right? Where the donor had acquired prior to 1st April 17, gift was received to me after 1st April 17. Again, as we know, gift is exempt. You take the cost of acquisition, period of holding of the earlier owner, etc. What if I had received an inheritance, where the inheritance happens after 1st April 17, but the original owner had acquired it prior to 1st April 17? What if I acquired it as bonus shares? Now, of course, bonus shares, the cost of acquisition is nil, and the period of holding is not passed through in that sense. But what if there were bonus shares? What if there was a merger, demerger, and because of which, so I was holding shares of an Indian company that was merged into another Indian company, and I got shares of the other Indian company post 1st April 17. What happens to that? Right? So what is important is, if you see the language, it says gains from the alienation of shares acquired before 1st April 2017. Now, in this situation, when I received the gift, have I acquired the shares before 1st April 17? No. Inheritance, have I acquired the shares before 1st April 17? No. On amalgamation, did I acquire the shares of the new company before 1st April 17? No. If I give a very, very strict interpretation. Bonus shares, did I acquire them before 1st April 17? No. Now, you have the grandfathering provision also in the case of GAR, and we'll just come to, because we'll need to equate that. And what is the difference, right? You have the rule 10UA of the income tax rules, which gives the grandfathering, which says the provisions of chapter 10A shall not apply to any income or accruing or arising or deemed to accrue or arise or whatever to any person from transfer of investments made before 1st April 17 by such person. So you had the CBDT circular of 2017, CBDT circular 7, where there was an FAQ that was there. And there the question was, will GAR provisions apply in case of security issued by bonus issue if the original shares were before 1st April 17 and the new shares are after 1st April 17, bonuses after 1st April 17, will I get the grandfathering under GAR? What about conversion of CCPS or CCD of fully convertible bonds or shares issued to pursuant to split up or consolidation? So merger, demerger, are they grandfathered or not for GAR purposes? So there the answer that is provided by CBDT is yes, it will be made to investments made after 1st April 17 in respect of instruments compulsory convertible from one form to another at terms finalized at the time of issue of such instruments. So shares that are brought into existence by way of split or consolidation, that is merger, demerger, or by way of bonus issue, bonus issue in respect of shares acquired prior to 1st April 17 in the hands of the same investor would also be eligible for grandfathering under Rule 10U. So CBDT has clarified that for GAR provisions, and again the difference is, if you see Article 13, the Singapore Article 13(4)(a), it talks about shares acquired, whereas GAR provisions talk about investments made, and therefore CBDT has said investments made. If I had made an investment in a company and I got further bonus issue, after that it is continuing to be investment made, and therefore I should get the grandfathering. Similarly, if I had invested in CCDs and now they became converted into another form in terms of equity shares, I should get the benefit. And therefore the CBDT said in all these, or if I had invested in one company, I got shares of the other company because of a corporate reorganization, I should do the investments made, and therefore I should get the benefit. So in these situations, CBDT has given that. Now the question is, can I use the same principle for shares acquired? Now, before that, when the treaties were amended, right? Again, very important to understand the context. If you see the press release of the Finance Ministry in 2016, which had notified the India Mauritius, or 2017 when India Singapore protocol, which are amending the treaty, there the protocol, the press release talks about investments made will be grandfathered. It doesn't talk about acquisition of shares. So it's a, Singapore also talks about investment in shares made before. So therefore, can I say shares acquired may not be strictly in that sense, but I have to look at a broader concept of investments made, because what is the context of giving this grandfathering, right? Because under the old treaty, when the provision stood as it was, I had invested in a particular manner. Because of whatever reorganization, etc., it has changed its form, but in substance my holding is in the same manner as it was. Then really should it make a difference? And in my view, that is why I would look at shares acquired in the same manner as investments made. And therefore, in situations where my investment was made in the company prior to 1st April 17, just because the form has changed, that should not change it should not impact the grandfathering, and those investments should be grandfathered. So coming back to our earlier one, now in the case of gift, obviously the gift is not investment made by me or shares acquired by me, and therefore in my view, gift in that case, while it is exempt, you get the same benefit of a pass-through, etc. A gift received after 1st April 17 cannot be considered as investment made or shares acquired by me. But if it is inheritance, right? Inheritance again, so we'll come to inheritance later, but if it is merger, demerger, or bonus shares, right? Those were technically not shares acquired, because those companies may not even have been in existence at that time, but had made investment in the underlying company at that time, and therefore, in my view, you should get these investments should be grandfathered. In the case of inheritance, again, it is not an act, but it is sort of more of a transmission, and it's not really a case of because an act of this thing, it is a transmission by law, and therefore there's a stronger case, in fact, that in case of an inheritance, I should still get the benefit of grandfathering. Now, coming to the next issue. One second. For tax purposes, yes, because it is preference shares. So for tax purposes, if I had invested in OCRPS prior to 1st April 17, converted them post April 17, then I should get the benefit, in my view. And therefore even Sarva Capital will be the same. I mean, of course, the language in Sarva Capital, the justification that initially they said that voting rights, etc. In OCRPS, you may not have voting rights. In CCPS, typically, a lot of times you do have voting rights. But I think finally, when they have concluded, they have said, initially also it was shares, now also it is shares, and therefore those were shares acquired. So OCRPS, I don't think there's any problem. It is shares. So you have an additional benefit of shares. But even otherwise, with that logic, even the logic that I have tried to give, that I had made that investment prior in one form, just because that form has changed, in substance my investment remains more or less the same. And therefore I should still, because what is the context of the grandfathering, right? Given the provision of law in a particular time, I had made an investment. Now just because you're changing the law subsequently, I should not be worse off. And that is why they have said that whatever you have made prior to 1st April 17, before the treaty was modified, it will be grandfathered. So that is what I would try and take that as a contextual justification. Right. Yeah. So in terms of valuation, now next issue, again, a very small slide on this. So some interesting issues that arise. Whether Section 50 CA will apply in case of a transfer of a foreign company. Yes, because 50 CA talks about unlisted shares which are other than shares which are publicly shares of company in which public are substantially interested other than that. So therefore, any unlisted shares also in a foreign company, 50 CA will technically apply. Of course, may not have significant value because there's no concept of stamp duty value, etc. in a foreign company. So therefore, it may not have too much of a significant value. But yes, I will need to make sure that I'm transferring shares at least at the net asset value. Now, an issue arises is if I'm transferring shares to an associated enterprise, what provisions will apply? Will it be Rule 11UA or transfer pricing? So let's assume that I've transferred shares under transfer pricing. So let's assume that I've transferred shares from resident to a resident to a non-resident, or a non-resident to a non-resident. In either case, it doesn't matter. Between associated enterprise, Rule 11UA gives me X value. For transfer pricing, I'll say arm's length, and therefore arm's length. The question is, do I look at Rule 11UA value or do I look at some other mechanism? Now again, in my view, 11UA means 11UA is the base. It says that it cannot be below that value, and 11UA is in the context of because you should not be making a transaction. Are you making a transaction in cash, etc.? That is the context of 11UA. So obviously it cannot be below Rule 11UA, but I have to also consider transfer pricing provisions. So it cannot be just that 11UA is the base, and therefore I've made above that, therefore it is at arm's length. No, I have to satisfy transfer pricing separately. So if there's a valuation report, I may need to get it to justify what is the actual arm's length value of this shares, and I have to satisfy both 11UA and transfer pricing. Now in Rule 11UA, there is an interesting issue that arises because if you see equity shares, it goes as per the net asset valuation, subject to replacement of certain values with for example immovable property or certain this thing, right? Whereas for any other asset, including other preference shares, it goes as per the value that is a fair market value, which is derived from the valuer's report. So we had an interesting transaction where now obviously CCPS is nothing effectively but equity in all fairness, right? So, but because it gives you different mechanism, ideally I will say that whatever is to be done for equity, I will do for CCPS, because eventually one CCPS, assuming is one equity share or whatever it is as per the conversion ratio, it is effectively nothing but equity. But in this particular situation, because it gives two different mechanisms, it says for equity shares you compute in a particular manner, for any other asset you compute it as per the valuation report. So then my Rule 11UA value changes. If I'm transferring, in a situation where I'm transferring equity shares as well as CCPS, while in terms of fair value everything is the same, but in terms of the consideration, Rule 11UA, that changes, and therefore that could have an impact there. So it will be any other method, and I'll look at a valuation report. Okay, so I'm now on to the last issue, and I think we have 10 minutes, so I think we are in time. So indirect transfer, I think we'll quickly just some of these issues that are there, and I'll try and cover those. So indirect transfer, we all know Section 911 after the Vodafone in 2012, 911 was amended, which said that any income accruing or arising, whether directly or indirectly through the transfer of a capital asset situated in India, shall be deemed to accrue or arise in India. You had an explanation 5 that was added to 911, which said that if the value was substantially derived from assets in India, transfer of a capital asset, it derived value substantially from assets in India, then that would be considered as a asset that is situated in India, capital asset situated in India. Explanation 6 provided to 911 again provided that what is meant by capital value deriving substantial value of assets from India. So you had the value of 10 crore, that is minimum threshold that is given, and more than 50% of the value of the assets. Again, you had explanation 7 that has been added in 2015 to say that provides exemption in certain cases where there is no transfer of right of control and not more than 5% of the voting shares are held, then there should not be any indirect transfer. Now whether the question is, I have to derive, right. So I have to look at, the question is, I have to look at substantial value of assets in the context of uh, indirect transfer as on the specified date, right? So it is as on a specified date. I have to see whether I have to look at as on specified date. I have to look at whether the value of the assets in India are is a substantial portion of the value of the foreign shares. Now there you have explanation 6D to section 9, which provides what is a specified date, and it gives two clauses. It says date of the accounting period of the company. Date of the accounting period of the company preceding the date of the transfer or interest, or the date of transfer if the value of the assets exceeds 15% of the value of the total assets of the company. If there's a change of more than 15%, then you look at the date of transfer. So again, I think so one needs to do a computation. So here in this case, you have in this particular situation, you have, let's look at the balance sheet as on 30, you are transferring shares on 1st April 2025. You have your net worth of your assets are 100 if you see on 31st December 2024, and 1st April 2025, you have net worth of 1200 minus 330, sorry. So, so you have, so yeah, so the question is, if you see explanation 6 to section 91D, it says you compare the value of assets of the company. Now, do I only look at the asset side of the company I compare, or do I look at the net worth, the net assets, right? Because in this case, if I look at, clearly I look at only the asset side. 31st December, 1000 is the value of assets. 1st April it is 1200, and obviously therefore there's an increase of 20%, or I look at my net worth. So as on 31st December it is 300, as on 1st April 25 it is 330, which is not more than a 15% increase. So what is to be seen is the question. Again, no clear answer. This is some issues that are there. In my view, you will need to consider the net assets because not just the balance sheet asset side. You have to look at the net asset value, and if the value of the net assets have increased by more than 15%, you will compute. You will look at the date of transfer. You will compute the. You will do the computation of whether it is substantial as on the date of transfer. Right. Now again, I'm not going into the detail of this explanation, this thing, but just quickly, in terms of the valuation under Rule 11UB, as well as explanation 6, right? I mean the way the mechanism is provided. Again, the issue of whether you compare only asset side with asset side, or you also consider liabilities. So if you see explanation 6 to 911, it says the value of the asset shall be the fair market value as on the specified date of such asset, without reduction of liabilities in respect of the asset, determined in such manner as may be prescribed. So if I see explanation 6, right, if I have invested in a company, I will look at the value of that company as against any liability that I have taken on that manner. But if you see Rule 11UB, what does Rule 11UB, which gives mechanism of how the fair market value is to be computed? It says where there is an Indian company which is not listed, you compute your fair market value as increased by the liability, if any, considered in such determination. Similarly, for foreign company also is the same thing. If it's unlisted, you consider your fair market value as increased by the value of the liabilities which have been considered, if any, for such determination. Therefore, if I am following the DCF method of calculation, then I do not need to go into, because in DCF I don't consider liability per se. It is only afterwards when I'm computing after the enterprise value, I add back any significant assets or reduce any borrowings. Then yes, I will consider. But purely in the DCF calculation, the enterprise value, typically I will not look at the liabilities that are being considered. But I'm computing under the net asset method. Then I'm doing assets minus liabilities, so I'm considering the liabilities. So it sort of gives a little bit of a mismatch, where depending on the method that I'm following, it will determine whether I have considered any liabilities for that valuation and whether I have to add it back or not. Again, in the interest of time, we will not go in depth into that. Preference shares, right? Preference shares are considered as liability. It is not considered as an equity share. It is not a share or a part of equity, but it is considered as a liability under explanation to Rule 11UB, because it says what is considered as book value of liabilities means value of liabilities of all the liabilities excluding paid up capital in respect of equity share or members' interest, and therefore and reserves and surplus. So therefore, any preference share possibly is considered as a liability when I'm computing the value of the Indian company or the foreign company when I'm doing the valuation. Yeah, last point I'll cover. Interestingly, if you see the rules, so here in this case I have US company having a, say, a French company below it, having an Indian company below it, and Indian company further has a subsidiary, say in Singapore, Sri Lanka, wherever it would be. Each of them is an operating company, SPV as the case could be. Now, if US company is selling shares of the FCO, then I have to look at whether FCO derives its value significantly from assets situated in India. So I look at valuation of ICO. Now, ICO has investment in Singapore company. So logically, I have to look at only assets situated in India. Singapore company is not an asset that is situated in India. Therefore, logically, I should not consider Singapore valuation because it is not a part of Indian assets per se. But rule says, no. The moment you reach Indian company, anything below that is a part of Indian asset. It is considered Indian assets. And therefore, is there a difference between what the explanation 5 to section 911 says, where it only talks about assets situated in India, versus what the rules say? Is a question, because the rule says when I'm doing the valuation, I stop at Indian company, all the values below it are all deemed to be Indian. Any structure below it is all Indian, and therefore I will only consider the Indian company shares. Under the treaty, as you all know, indirect transfer is exempt in most treaties because it falls under the residual clause, except in the case of US and UK, because it says that any capital gains arising will be taxed as per the domestic tax law. Yeah, just last point is whether if the value does not exceed 50%, the question is, do I need to file form 49D? Because if you see section 285A, it says 49D is required to be filed only if substantial value is derived from India. But if you see the form, it asks the question that is it deriving substantial value from India or not, and therefore if one only looks at the form, one will say that okay, even if it is less than 50%, I have to fill up the form 49D, which in my view is not the case because form cannot override the section. If it's below 50%, obviously I don't need to fill up 49D, it is exempt under the Act itself, I don't need to do any compliance. Obviously, if it is exceeding 50%, I have to fill up 49D, irrespective of whether it is exempt under the tax treaty or not, because it may not be taxable under the treaty, but I have to still fill up 49D because values are substantially derived from Indian assets, and therefore under the Act itself it is taxable, and therefore 49D could still apply, but otherwise less than 50%, clearly 49D does not apply. Thank you for a patient hearing, and thank you once again to the organizers for having me here. Thank you.
Thank you, sir. Thank you, sir, for your valuable time on this Sunday morning. Members, you will agree that sir has explained us the integrity of the cross-border transaction and taxation of the shares on the cross-border transactions with the examples of case laws and DTAA. I request C.A. Sikandar Yadav to please give hearty vote of thanks to this, sir.
Vishal bhai. It is a great privilege and honor to propose well-deserved vote of thanks to CA Mahesh Nayak. Thank you, sir, for accepting our invitation for the topic practical issues in capital gain in cross-border transaction. Sir has covered the topic in detailed manner, covering topics with practical examples and case studies. Thank you, sir. Now I request members for a loud applause.
We'll have a break of 5 minutes. We have change of dice. We have our second speaker here, Rakesh Kapoor ji.